Most penny stocks don't fail because they're small. They fail because investors never filter them properly. People think the danger is the low price. The truth is, price is usually the last problem. The real damage happens much earlier, at the decision stage, when excitement replaces discipline. That's where almost everyone loses quietly, repeatedly, and without realizing why. Warren Buffett understood this decades ago, not because he studied penny stocks, but because he mastered something far more important: elimination. His real skill was never finding great investments. It was rejecting bad ones, fast, unemotionally, and without regret. And that's the principle that filters out nearly 90% of bad penny stocks before you ever look at a chart. Most investors start with the wrong question. They ask, how much can this go up? Buffett always starts somewhere else. He asks, what could permanently destroy this business? That single shift changes everything. When you look at penny stocks, the temptation is obvious. A low price feels like opportunity. A small market cap feels like upside. But cheap does not mean durable. And without durability, time works against you, not for you. Buffett has always believed that the real risk isn't volatility, it's permanence. The risk of owning something that slowly erodes quarter after quarter until the story quietly ends. No crash, no headline, just dilution, debt, and disappointment. This is why his filter is so powerful. Before numbers, before forecasts, before valuation, he asks one brutal question: does this business deserve to exist 10 years from now? Most penny stocks fail instantly at this stage. They rely on one customer, one contract, one trend, one funding round. Remove any of those, and the entire story collapses. Buffett avoids businesses that require perfect conditions to survive. Think about it for a moment. Would you rather own a company that needs a massive government grant just to keep the lights on? Or a quiet, boring company that sells a niche industrial product every single day, regardless of headlines or hype? One depends on rescue. The other depends on reality. He prefers companies that can be average and still live. Because survival compounds, fragility does not. Now here's where most retail investors get trapped. They confuse activity with strength. Press releases, partnership announcements, new product launches. It feels like progress. But movement is not the same as momentum, and momentum without a durable engine is just noise. Buffett's filter ignores noise completely. Instead, it focuses on something far less exciting: whether the business can internally sustain itself without constant rescue, not grow fast, not impress Wall Street, simply survive without begging. That's why this principle wipes out most penny stocks instantly, because many of them are not businesses, they are projects. They exist to raise capital, not to generate it. And once you see that distinction, you can't unsee it. A real business produces value first, explanations second. A weak business produces explanations first and hopes value arrives later. Take a look at your current watch list. Be honest with yourself. How many of those are real businesses? And how many are just projects, hoping something finally goes right? Tell me in the comments. I'm genuinely curious how many of you are already filtering this way. Buffett has always walked away from hope-based economics. Now let's apply this thinking to the under $10 space. When you look at a cheap US-listed stock, forget the ticker for a moment. Forget the chart. Ask instead, if markets close tomorrow, could this company still function? Could it pay employees? Could it service obligations? Could it continue operating without issuing new shares or borrowing more money? If the answer depends on as long as that's a warning sign, as long as funding continues, as long as demand improves, as long as the next deal closes. Those are not foundations. Those are conditions. Buffett avoids conditional businesses, and that alone removes the majority of low-quality penny stocks from consideration. Here's why this matters so much. Most losses in penny stocks don't happen because investors bought too high. They happen because investors underestimated time. Time exposes weak structures. Every quarter is a stress test. Every earnings call reveals whether a business is building strength or just buying time. This is why patience only works when durability exists. Without durability, patience becomes denial. Now, when you finally apply this filter to a real under $10 US stock, something interesting happens. The list shrinks dramatically, but what remains looks very different from what most people chase. These aren't flashy stories. They aren't trending on social media. They don't promise revolutions. They are often boring, misunderstood, ignored, but they share one critical trait. They don't need constant saving. They have real operations, real customers, real economic activity, not perfect margins, but improving ones, not explosive growth, but survivability. This is where Buffett's thinking quietly intersects with smart penny stock analysis. You're not trying to predict the next big thing. You're trying to avoid the next permanent loss. And here's the paradox most investors miss. Avoiding losers matters more than finding winners. Compounding works best when nothing breaks. That's why this principle feels so simple, and yet so few people use it. It requires saying no. It requires walking away from excitement. It requires patience before optimism. Most people would rather feel early than be right. Buffett has never cared about being early. He cares about being inevitable. When you apply this filter consistently, your entire mindset shifts. You stop chasing every cheap stock that moves. You stop reacting to headlines. You stop needing constant validation. Instead, you start asking better questions. Is this business structurally sound? Is it becoming less dependent on outside capital? Is time working for it or against it? And when the answer is unclear, you do what Buffett does best. Nothing. That's the hardest skill in investing. Not analysis, not intelligence, restraint. Most penny stock investors fail not because they lack information, but because they lack filters. They let everything through and then wonder why their results feel random. This one principle changes that. It doesn't guarantee success. Nothing does. But it dramatically reduces the odds of permanent failure. And in markets, survival is the first victory. In the next video, I'm going to put this filter to the test. We'll take 3 of the most talked about penny stocks right now and run them through the Buffett filter. No excuses, no narratives. Only one survives. And the result might surprise you.